pressure from rising global oil prices, with the impact already being felt in higher transport and production costs across key sectors. The Central Bank of Kenya now projects inflation to edge up in the coming months, averaging 5.7% next month, rising to 6.0% in June and peaking at 6.2% in July 2026, before gradually easing. Mike Agwongo with the details.
Kenya's economy is once again feeling the heat from the global oil market, with rising cost prices pushing up transport and production costs across key sectors. According to the Central Bank of Kenya, inflation is expected to average 5.7% next month, rise to 6.0% in June and peak at 6.2% in July 2026 before easing later in the year.
But despite the expected upward pressure from high energy prices, Kenya's overall inflation is expected to remain within the target range in the near term, and this will be supported by appropriate monetary policy actions, the expected stability in food prices attributed to favorable weather conditions, and a broadly stable exchange rate.
The surge is mainly attributed to higher energy costs driven by global supply disruptions.
The inflation is projected to increase in 2026, mainly driven by a sharp increase in energy prices and fertilizer costs due to supply chain disruptions, again attributed to the conflict in the Middle East.
Central Bank of Kenya links the pressure to global tensions affecting oil supply routes, such as the Strait of Hormuz, which has pushed landed fuel costs significantly higher. Diesel import costs have risen by nearly 69%, amplifying domestic inflation risk.
The oil prices have now risen sharply and are quite volatile, again due to the supply disruptions and the elevated uncertainties attributed to the conflict in the Middle East.
The Kenya National Chamber of Commerce and Industry says the situation is already straining business and households, warning that fuel remains the backbone of the economy.
Kenya businesses cannot absorb another fuel shock of this magnitude without serious consequences on jobs, prices, and economic stability.
KNCCI Chief Executive Officer Kenneth Mutai says Kenyan business may not withstand another fuel shock, noting that transport costs have risen up by 25%, while production costs in manufacturing and agriculture are up between 15% and 30%.
Kenya's trade exposure to the Middle East, valued at over 700 billion annually, means that prolonged instability will directly affect key exports such as tea, coffee, horticulture, meat, undermining, of course, the foreign exchange earnings and market access.
For ordinary Kenyans, this means higher matatu fares, more expensive food prices and tighter household budgets in the months ahead. For the common mwananchi, the pressure is expected to persist in the coming months, unless global oil prices stabilize and domestic cost buffers take effect. Mike Kagwongo, TV 47, Nairobi.